everybody, welcome to the Basis Points Podcast. I'm Kevin Flanagan, head of fixed income strategy at Wisdom Tree Asset Management. I'm going to go back to a little bit of my roots in rock and roll and the Rolling Stones for the Fed Watch. This may be the last time. Remember that song? It's a classic for sure. Well, once again, the Fed kept rates unchanged at the July FOMC meeting. So as a result, the Fed funds trading range remains at 5.25 to 5.5. And this was the band that was introduced exactly a year ago, at July of last year, and still resides at a more than 20-year high watermark. And for those of you keeping track, this represents the 8th consecutive Fed meeting where the policymakers decided to take no action on the rate front. However, if the inflation and now labor market data continue to cooperate, this may be the last meeting where rates are left unchanged. And obviously expectations for that first rate cut are building for the next FOMC gathering in September. And this is exactly where U.S. monetary policy appears to be pivoting. While not explicitly stating that a rate cut is forthcoming at the September FOMC meeting, the voting members do seem to be guiding the money and bond markets in that direction. And specifically, the Fed is highlighting their dual mandate of inflation and employment now, rather than solely centering on progress on the price pressure front. And this emphasis on balance when it comes to the risks going forward is really the committee's way of providing forward guidance on the potential for a rate cut. So another rather important aspect of this Fed signaling has been Chairman Powell's continued use of the notion of being confident. In other words, the renewed trend toward disinflation that became evident in the second quarter is providing that springboard for cutting rates without fear of easing policy too soon. And by adding the employment aspect into the equation, the Fed has reintroduced the concept that future decision-making is now data-dependent, not just on inflation reports, but upcoming labor market data as well. And this is where things could get interesting. At the June Fed meeting, remember, the policymakers dialed back their dot plot to show a forecast of only one rate cut rather than the 3 cuts that were in place beforehand. Now, the release of the better-than-expected CPI and core PCE readings have rendered this new dot plot as being almost immediately obsolete. And heading into the July meeting, the implied probabilities for Fed funds futures were now showing an expectation moving towards 3 rate cuts for the remainder of this year. What's interesting is that once we get that first rate cut out of the way, I'm going to continue to emphasize that the central part of the investment landscape going forward is quickly going to turn to what type of rate cutting cycle this is going to look like. You know, if future economic reports, think the labor markets, don't reveal any signs of visible weakening, then this easing episode will be based on the concept that the current restrictive policy stand is no longer warranted because of the progress on inflation. And that could more than likely result in a more deliberate rate cutting phase. Now, what's the other side of the trade? Well, if the Fed were to see higher unemployment rates, continued disinflation in the months ahead, that would arguably create the environment for a more aggressive easing stance. So, what's the bottom line as we sit here? I think the overarching theme from Powell and Company in public appearances has been that while rate cuts seem like a reasonable case scenario in the months ahead, that Fed officials would still like to see more data to get them over that final hurdle. And if that upcoming data does continue to cooperate, as I mentioned earlier, it's possible Chairman Powell could provide such forward guidance for a rate cut at the Kansas City Fed's Jackson Hole Symposium that's scheduled to take place in the second half of August. So I'm going to leave it there. I hope everybody has a great rest of the week and be well.